Welcome to Something to Talk About from the Bainbridge Island Senior Community Center. And we're grateful you're here. We're also grateful Paul Merriman is here. And we're going to hear about, as you can see on the screen, 10 ways to get more income out of your investments in retirement. And this program is being presented in cooperation with the Bainbridge Community Foundation, which has for the last several years regularly provided with Paul's support and underwriting the series on financial readiness, which is a wonderful thing to keep an eye on. And the Senior Community Center is happy to be co-sponsoring this. We are also grateful for Fieldstone Communities of Bainbridge Island, which offers residential care and support for independent living and assisted living and memory care up on Rolling Bay. And I invite you to go to fieldstonecommunities.com and check out what they have to offer or ask about a tour. Paul, thank you very much for joining us. I know we have a little problem with your camera, but we see the presentation just fine.
Good. All right. Well, I appreciate your patience. And when I do a presentation for the senior center, I always ask, how interested are they going to be in a whole bunch of tables? And I've come to the conclusion that those tables are not their favorite thing to spend their time on. So today I'm cutting my table time in half, but I'm still going to use a few tables because I don't know how to live without them. But I still want to show some legitimate ways that I believe with very little effort and certainly very little additional risk that you could in fact have more income from retirement in your retirement. The mission statement, briefly, I am not an investment advisor. I was once retired and established a foundation for financial education. And so I teach, I write, I do podcasts, we do videos, all attempts to teach people to be better investors. We start at the college level, actually the high school level, and try to go all through the way through retirement. So today I'll talk a little bit about being a young investor, but only for a couple of minutes. And here it is. I want to make the decision, the difference, focus on the difference between the person who is young and in accumulation and gathering money towards retirement and the person who is in retirement. The fact is that young investors are supposed to focus on offense. That would imply the stock market or stocks. It is all about maximizing your savings rate. You don't make any money on those investments until you get that savings up so that it becomes a significant amount. You typically are going to be using dollar cost averaging, guaranteeing yourself to put money into the market and buy more of it when the market is low and less of it when the market is high. You're going to be, as I said before, mostly in equities, and bear markets are great for a young investor because they allow that person to invest in cheap shares that will theoretically be worth a lot more later on. When we are retired, and I am, we focus more on defense. I've always been a little afraid of the market and not always been as offensive as I should, but certainly when I retired, I became more defensive, and that defense can show up in a whole bunch of different ways. I actually have a list of 25 ways to be a defensive investor. But the simple, obvious ones are that low expenses are a huge defense against losing money that you don't have to lose by buying investments that have lower expenses. So you get rid of the high expenses, go to the lower expenses, keep your taxes low, add more fixed income as a defensive step. Increase your diversification. I do run into a lot of investors who still have major positions in individual companies. And the textbook would frown on that, but people are oftentimes married to their investments that got them to the successful retirement they have. And a lot of people do give serious consideration to defending against that one company having problems. And of course, the bear market is not an advantage to a retiree, because not only is the market going down, but you're spending the money rather than adding the money. And so all of those, we want to find ways to defend against all of these forces. I will be at Western Washington University, where I am proud to say not only have they been willing to teach a class that my wife and I have been supporting now for over 10 years, but they have also agreed to create a course that every student who comes through Western will have about 40 hours of financial literacy that they'll be exposed to. And when I am talking to these young people, before we get into investing, I really want them to focus first and foremost on the math of investing. And it has something to do with today's conversation. So when I'm talking to that young person next week, I've got about almost 300 young people I'll be meeting with. I want them to understand that little differences in what happens during the period of accumulation can make a huge difference later on. So I showed them this example. Let me see if by chance I've got a pen here that I can capture my, just a second here. Yeah, there we go. We assume an 8% return over the first 40 years, the accumulation period. We assume $6,000 a year, starting at 25, 40 years of that, retiring at 65. Then we get to retirement, where you guys come in for the last 30 years, and retirement at 95, and take 4% a year out of the retirement portfolio during that 30-year retirement period. You made 8% during the accumulation period. You take less risk, you make 6% during the distribution period. What do we know? What does that mean? That means that if you invested $240,000, at the end of that first 40 years, you'd have almost 1.7 million. Then when you retire, you take out about 2.6 million. And at the end of your life at age 95, you give 2.8 million to others, which means that the real return on your 240,000 is the combination of what you spent, took out to use in retirement, and what you left, which is 5.5 million. Now, here is where this small difference starts to show. If you could have just made 8.5% instead of 8, and during the accumulation, and 6.5 instead of 6 during the distribution, what would have happened to those numbers? Well, you would have had a relatively small difference at the end. I mean, it's not huge. It's 1 point, I'm talking about at age 65, the end of your work life, 1.9 versus the 1.7. Doesn't feel life-changing. But when you then continue using that money in retirement, instead of taking out 2.6, you take out 3.2. Instead of leaving 2.8, you leave 3.7. The impact of all of this total 75 years of investing is a $1.5 million difference because of 0.5%. So what I try to teach these young people is there's an industry constantly in our face, in essence saying, let me help, and let me have a part of that return that the market is going to give you. And there are at least 10 ways that they hold their hand out to help, and every one of those 10 ways imply lower returns for you. Now, I don't want to give up those unless I have to. If I have to, that's okay. For example, when you buy a mutual fund because you don't want to manage that money, well, okay, you have to pay them something. We'll talk about that in a minute. I do also want to make note that when we go to this next table, instead of 8 to 8.5, it's 8 to 9. Instead of 6 to 6.5, it's 6 to 7. And the difference now is not 2 times 1.5, but it is now 3.5 because you're making money on extra money that you made. And so again, if we could find somewhere in an individual's life experience with investing an extra 1%, it's worth the attempt. It's a big deal, actually. So where can we find another 0.5% or 1% or even more to either spend or leave? And so here is one really simple one. I find a lot of people are sitting with money in money market accounts. We'll call these cash and cash equivalents. Something you can get your money out at any point, but you're getting something while you're there as a premium for putting your money wherever you put it. So we can go to bankrate.com. This is just a great data source on what kinds of returns can you get. And they do make note, by the way, of an average. They say the national average for money market rates, these are not checking accounts, these are money market rates, is about almost 0.6%. But I know there are some of these we'll talk about checking accounts in a second. Here's what I know. I know that the range for money markets are from 0.25% to 5.25%. So if you're in one that is paying 2, then the question is it worth the effort? Is it enough money? If it's $1,000, you might say, well, it's not worth it. If it's 10 or 20 or 50 or 100, all of a sudden there is a difference worth considering. And sometimes it's just so easy to do everything at the bank you're at or at the brokerage company you're at, wherever it is that you have your money, that to take the time to do this just doesn't seem worth your while. On the other hand, if in fact you could do this in a way that was relatively simple and you felt like, well, and maybe I wouldn't have to do this again and again and again, chasing rates of return, it might be something worth considering. And then there's checking accounts. Checking accounts, as many of us know, have almost no premium for leaving the money there. Some pay as much as 5%. Fidelity has a program, 2.7, Betterment 5%, Vanguard 5.4%. Now, by the way, when you get into some of these checking accounts through non-banks, traditional banks, you will find there are things you can and you cannot do. You, for example, can easily wire money out of an account, maybe at a Vanguard, into your checking account to write the checks, or you can write checks there. But there are some small limits that you might have on the size of the check. So you might not be able to use it for all of your checks. So is it worth the difference between whatever you're getting in your checking account now and the 5.4% at Vanguard? And by the way, any numbers I give you here are at least 3 or 4 days old. So they're going to change, I promise. And so you have to check it. So don't take these as gospel. But I think right here, in such an easy thing to do, is worth considering. But the certificate of deposit, oftentimes I find retirees have fairly substantial positions in certificates of deposit, CDs, and it's not a minor item in their portfolio. In fact, in the fixed income part of their portfolio, what they do instead of having their money in bond funds, they use CDs. And here again, we run into lots of great help from bankrate.com. And I happen to know their average, as they show it, for 1-year CDs is 1.7. I know that you at bankrate.com will find those in the range of 4.6, 4.5, 4.7 for a 1-year CD. Now, there are some problems when you start using bankrate.com because You find the best CD rate, and then when it is matured and you have your money back, the company or the bank that has the best CD rate is somebody else. So now I got to go open a new account. It's a bother. Well, lots of brokerage firms handle what are called brokered CDs, and they are bank CDs, but they are the buyer on behalf of their clients. And now all of a sudden, you can shop from the best returns that Vanguard can find on your behalf. Now, Vanguard is doing this free for you because there's no commission, but they do make it very plain that they do get some compensation from the banks. But I just looked at what their rates were. I think yesterday their 1 year was 5.1, their 3 year was 4.8, their 5 year was 4.5. Now all of a sudden, under one umbrella, you could have less than $250,000 in a number of different CDs. And as they mature, it can all be reinvested immediately right there without having to move the account around. Certainly, I think worth consideration. Last week, I interviewed Stan the man, actually Stan the annuity man, who is probably the most knowledgeable person that at least certainly that I know in the country on the whole field of annuities. And he is not surprised when people say there is no way I am ever going to do business with an insurance salesperson just because insurance companies have a bad rap. Well, in fact, there are a lot of products that are pretty basic, almost you would consider them a commodity. And one is the multi-year guaranteed annuity, MIGA. MIGAs are not very popular with insurance people, salespeople, because they pay almost no commission. And so they are, that's not where the big money is. As I understand it, I'm not an insurance person, but in the industry, this is not high profit work. But by the way, they used to be called fixed rate annuities. That's what they are. But now it's fancier than that somehow. But the returns are similar to CDs. Particularly, Stan said when I interviewed him, if you are less than 3 years. But he makes the point that if you're 3 to 10 years, that the rates are very competitive with these guaranteed. Now, guaranteed is by the insurance company. So Stan would say to be very careful about investing in a low-rated insurance company because it had a higher return. And by the way, it is interesting that there are plenty, and you'll have a chance, not here today, but if you go to Stan's site, you'll be able to see all sorts of companies. As a matter of fact, what Stan allows people to do is see all the rates that he has available right there and the companies that offer them. And what's I think is fascinating is the huge spread of returns from maybe 3% on an annuity that somebody else is paying 5 or 6% on. And it doesn't make any sense how that company would even survive. But Stan explains, and I do hope, and I've got a link later on in this presentation to his presentation, and I have a PDF. I'm not sure how I'm going to get the PDF to you at this point, but we'll have in fact, maybe it's possible Reed would even have that PDF available through wherever you're going to have this information available.
We can post it. This video will be on
Okay.
youtube.com/BI Senior Center. And in the related links, we'll put a link to your PDF.
Terrific. But the reason that one company pays very little is because they don't want that money. They have to balance out their positions in these different periods, and you'll see this true if you look at the other kinds of insurance products like the single premium immediate annuity, which is in essence a pension. I'll talk about that in a few minutes. Again, the range of payouts is huge, and the number of companies that offer these products is very large. There are a lot of them. But with these multi-year guaranteed annuities, the MIGAs, you can actually not only defer for the 3 years or the 10 years any taxes on this CD-like product, but at the end of the maturity, let's say at the end of 3 years, you can roll it over and maintain its tax deferred status. And you could do that for any number of years. And it may be, and I'll talk a little bit about these single premium immediate annuities in a few minutes. You may even want to convert this into a lifetime annuity payout that you're guaranteed a certain amount every month. So there are some really good factors here. Now, Stan has a great book on the multi-year guaranteed annuity. He's got a great book on the single premium annuity, the immediate annuity, and you'll get those books, those free books, at his website. And by the way, Stan is the only person in the industry that I know that creates all this educational material. He's got like 1,000 videos and podcasts, and he just does a great job of educating investors. Now, one really easy way to have more money in retirement is to simply take it out and spend more. And I in all my years, my 30 years of being an investment advisor, I always enjoyed this discussion about how people think about the amount of money they take out. There are people who take out 2 and 3% a year, and they could easily take out 3, 4, or 5% without doing anything risky. But some people just want to play it safe. There's something out there lurking that's going to get them and bite them, and they want to be prepared when it happens. Well, we produce a whole bunch of tables. We have over 200 tables on our website because we're trying to help do-it-yourself investors. And my view is a good do-it-yourself investor is going to know almost as much as an investment advisor. So we try our best to show you the numbers that any investment advisor would likely know. But here's the difference. I want to talk here about the difference taking 3 or 4%. That could be a substantial raise in what you have to spend. You also may or may not be adjusting your portfolio for inflation. We have tables where we do adjust for inflation. We have tables where we don't adjust for inflation. And the other thing that people are concerned about, if I start spending 4 instead of 3, I'm not going to leave as much to my heirs as I otherwise would. And that's a legitimate concern, and I'm sure that your children and charities thank you, but those are all part of that decision making. I want to show you a little part of a table. This is one of a whole bunch of tables. Each table has an equity. These columns represent the returns, starting with $1 million and taking money out every year. In this particular case, starting with $30,000 and increasing it each year by the inflation that happened during that year, the previous year. So it has an adjustment automatically so that you maintain your lifestyle. Now, there are a lot of questions about the validity of those inflation numbers, but in order to have some sort of a benchmark, this is what we use, the Consumer Price Index. Now, you could have all of your money in bonds. You could have 10% of your money in stocks, 90% in bonds, 20% in stocks, 80% in bonds. And as you go across this table, you get across to 100% equity. And in this particular table, the 100% equity is the S&P 500. The total market index would be virtually the same, but it wouldn't be the same as a technology index, for example. So this is one generally accepted as the benchmark of all of the indexes for US securities. But what we do here, and this starts in 1970, and the table goes all the way through 2023 on our website, but it allows you to see what was your account worth at the end of each year and how much was taken out. And then at the next year, you took out 31,671. And while at the end of the first year, you had almost 1,120,000, at the end of the second year, you have 1,178,000. So you can see what's happening to your all bond portfolio. By the way, this is a very low risk, short to intermediate term bond portfolio. No high grade corporates, no high yields, very, very high grade in that they're US government. And if we will go over to 50-50, my wife and I, we happen to be half in stocks, half in bonds. We have more asset classes than the S&P 500, but this, I think, again, is a better benchmark for most people. You'll notice that at the end of that year, you had more money left sitting in the bonds than if you had stocks in your portfolio, because the stocks didn't do very well in 1970. And you can see here in 1974, they were terrible, obviously. The S&P 500 went all the way down to $760,000. And I can tell you from having been around that industry for 30 years, there are very few couples that both are comfortable with that, which is why so many people are sticking around the 50, 40, 60 to 60, 40 area for most retirees who have stocks in their portfolio. But you can see then at the end of 20 years, with all the bonds, you've got 3.5 million. With 50-50, you've got 4 million. So this is with 30,000. But what happens if you take the step and make it 40,000? Well, I should make one thing very clear. I want you to notice the first year of this 20-year period, the distribution was 30,000. In order to replicate the inflation that happened the last year here, 1989, you had to take out $95,889 to have the same buying power. This was a period, as you may remember, we're old enough, most of us, to remember that inflation was a real problem. We may be on the edge of that kind of a problem now. Nobody knows for sure. But from 30 to 95, more than 3 times in 20 years. Now, obviously, recently, well, other than just very recent, we haven't had that kind of problem. But I do want you to notice, though, that when you go to 40,000, now all of a sudden, in the last year, you're taking out 127,000. So you are taking out a lot of money. But that meant you got to spend more money or give it away. On the other hand, see what you left here before, when it was 30,000 coming out, the 50-50, you were left with $4 million. When it's 40,000 as the starting distribution, at the end of 20 years, you're down to $2.6 million. So changing it from 30,000 to 40,000 as an example of a 1% increase has an impact. But that impact is it's the teeter-totter is enjoyment of the money versus somebody else on the other end of the teeter-totter that you leave more to others. So these are big decisions, but that is a way that you could, in fact, have more money to spend in retirement. Now, another way to have more money is to increase your investment in equities by 10%. Take a little bit more risk, and I'll show you how much, and add another 0.5%. That's an interesting aspect. When you have equities and bonds, every time you add another 10% equities, you add on about 0.5% more return. So let's take a look at a table that shows everything from 1970 to 2023. I do not want you to try to read any of those numbers, but I will tell you what it is so you'll get the feeling. All of those distributions we just looked at were driven by this page of numbers. This is what we call a fine-tuning table for people who want to really think deeply about how much risk they're willing to take for how much return, because there always, almost always, is a relationship. I mean, when we can get CDs that are 3 or 4% higher, that's a big deal because there is no more risk as long as we're not over 250,000. But here we do take more risk. And so what we've looked at here is every year, how did the person who didn't have any stocks do? How did the person who had all their money in stocks do? And then the 10, 90, 20, 80, et cetera. So you have all of these different combinations. What I will think you'll be able to see is the bottom of that table here in this slide. And the thing that I love about this slide is it's what people really, in theory, care about. I can give them a whole bunch of numbers over the years, but what they want to know is what's the bottom line and how do they compare? Well, here is the bottom line. The annualized return over that 54 years of the all bond portfolio was 6.7%. Now that's a big return. That's higher than the historical averages going back, for example, 1928. We have those as well. But it was a period where there was very high inflation and interest rates got sky high during part of that, but then they went way down as well. But notice, as you added 10% in equities to the bond portfolio, the return goes from 6.7 to 7.2. If you go 20% in equities, it goes from 7.2 to 7.7. Now, this is over 54 years. I'm 80. If I get another 10 years, I'll be thrilled. And so I have to be realistic that the next 10 years could look very different from these annualized returns, whether it's the all equity or the all bonds or anything in between. But at least this is 54 years of data. Now, those returns don't mean anything unless somebody can tell me how much risk did I take to get that return. Well, I've got it for you right here. Let's just look at the worst 12 months. The worst 12 months for 100% bonds, and it happened not so long ago, was a loss of 10.5%. That shook up a lot of people. They concluded that bonds are not a good place to be. Well, the part that's interesting about that is that bonds are in the portfolio to stabilize the portfolio when the equities market is doing poorly. That's the main. Bonds are not there for income. The income doesn't amount to very much. Well, it's not peanuts, but the big money is made from the growth of the equities. So what we do know is that it did its job when the stock market went down over 20 and bonds were only down 10. I mean, only is not how you felt at the time. I mean, that was a disaster, I'm sure, in the minds of a lot of people. But notice when we add 10% equities, that worst 12 months goes up to 10.9. I don't even know that people would know the difference because they wouldn't be measuring the differences that carefully. But as you go to 20% in equities, we're up to 11.4 as the worst 12 months. And again, I don't think there's much difference there. And as a matter of fact, if we looked at the worst 5 years, 60 months, the worst return was a gain for the bonds of 0.3, and for the 20% in equities, a positive 2.2. So in a sense, you took more risk and you got a higher return with the combination of 20% in equities. Now, all I want to focus on that I think is important here, I'm looking for a 0.5%. I'm seeing that I could probably make an extra 1% here, at least looking back over these years, and be within the same risk tolerance. And so what I think that is a legitimate risk to take, well, I think over a period of time, it is worth it. On the other hand, I've had people who had 10% in equities and 90% in fixed income. And when the market went down and it was losing a lot of money, it drove them nuts. And so there are a lot of people that having equities in the portfolio, even if it's going to make you rich, it doesn't make any sense because you're more likely to bail out at a really bad time. But as you follow this on across, like to where my wife and I are, we're 50-50. And so we expect we could experience 23% loss. Now, that happened once. And there were a lot of really, really good 12 months. So this is not like this is a catastrophic event you have to face every year. But the reality is you don't know when the next year where there's going to be a 23% loss is going to come. Last year, or the year that the market was down and bonds were down, we were well within our risk tolerance according to what we said we were willing to lose. Because when you go 50-50, you are saying, I am willing to lose 23% of the value of my portfolio over a 12-month period because I believe it will come back. And that's a good thing to believe historically. So now we can look at that same distribution with the S&P 500. And you can see, now, by the way, this 20 years is a fascinating 20 years to look at. The first 10 were terrible as a decade. No, not terrible. Were mediocre. The S&P 500 compounded at 5.5%, I think. On the other hand, the next decade, I think the market was up like 17% a year. But I want you to see that as you had more, for example, here, if we looked at the all bonds at the end of 20 years worth 2.4 million versus, let's call it 2.6 million for 20%. For the 50-50, 2.6 million. Now, would the bother of the market going up and down be worth that additional money? Maybe. I don't know. Depends on what you believe about investing. When you see the rest of this table, by the way, and I don't have it here, the difference between the 100% bonds or the 10 or 20% equity and the 50-50 is absolutely huge over the entire 54-year period. But things got better and better as the time went on until they got worse, 2000, 2009. So it's, I hope if you go to our website, if you are interested in the distribution tables, you'll take a look. Expenses, lower expenses, very important, and very important in terms of making better returns. If you take two portfolios that are basically the same, what the academics tell us is that the best predictor of future returns of those two will be their expense ratios. That will make a difference, and it will typically be the difference very close to what that expense ratio difference was. Now, we'll talk about taxes in a minute, but before you take taxes into consideration, the expense is the big deal. And here's the thing. The S&P 500, and I included here one from Vanguard. And by the way, I am a Vanguard fund, and yes, I will be speaking at the Bogleheads conference in Minneapolis. But I can tell you that Fidelity and Schwab, they all have very low cost S&P 500 instruments. But I do know what the average expense is in that kind of fund. If we include not just the S&P 500, but the actively managed funds that work within the S&P 500, the average expense for the rest of those funds is 0.82%. Now, that tells me if I'm sitting, particularly in an IRA or for a 401k, if that's where it is, in an actively managed fund that's getting a high return, I mean, a high expense charge, I could do better, more than likely. And we'll talk about how much more than likely it is in just a few minutes. And here's a famous balanced fund. The Vanguard is a 60-40. Its internal expense ratio is 0.07. Its average return, its average expense ratio in the industry is 0.83 for a 60-40 balanced fund. That's a huge difference. And it shouldn't surprise you that the Vanguard Balanced Fund was in the top 25% of its competitors for the last 3, 5, 10, 15 years. So these are steps that people could take if they are sitting on mutual funds, similar mutual funds that have higher expenses. Here's something else you could do. Now, for some people, this is going to be too racy. It's going to suggest a higher risk, considerably higher risk. But you can, in your equity portfolio, by adding 10% small cap value to your portfolio, you can add about 0.3 to 0.4% for every 10% that you add a small cap value. Now, I am not recommending for retirees that they put much in, but certainly a 10% and even a 20% of the equity position, studies show actually creates a higher safe withdrawal rate, because while it goes up and down kind of with the S&P 500, there are times it does terrific when the S&P 500 does poorly. There are times when the S&P does terrific and small cap value it does poorly. But small cap value makes, I think, 1.7% more per year, and the risk difference is very small at 10%. In fact, it almost none. Here is a fine-tuning table. This is a different fine-tuning table. Before we had bonds over here on the left, over here. Now we have the S&P 500. Over here we have an index of the small cap value stocks. And then again, I'm not going to ask you to look at the fine tuning here on the numbers closely, but I want you to notice over here on the far right, we show you the difference in return year by year. And the difference in return is shown in the asset class that was best that year. So the first year, the S&P 500 beat the small cap value by 5.4. Then the next year, small cap value beat the S&P 500 by 0.6. So you can go down and see how that has gone back and forth over the years. But let's look here at the implication of having I'm talking only about your equities, the S&P 500, and then we have a small cap value on the far right, and small cap value 13.7, S&P 500 10.7. That's looking more like a 3% difference, not a 1.7% difference. And notice what happens when you add 10% small cap value, 90% S&P 500, the return goes from 10.7 to 11. If you add another 10%, it goes from 11 to 11.4. So if you have the risk tolerance, and we'll talk about the risk in just a second, you might be able to pick up an extra 0.5 to 0.7 with a 20% position. Now let's talk about the risk. The worst 12 months for the S&P 500 was a loss of 43.3%. With 20% of the portfolio in small cap value, the worst would be 44.5. So you would have lost 1.2% more in the worst 12 months. If you looked at the worst drawdown, oh, by the way, if you look at the worst 60 months, 6.7 and 6.9, very little difference. The worst drawdown from a peak to a valley, no particular time period, just how far down did it go? Well, at one point, the S&P 500 went down 51%. By the way, it did that in the mid-70s, did that in the early 2000s, and it did that again in the 2007 through 2009 bear market. So a 50% decline in the market and the S&P 500 is not unusual. If we looked at the 50-50 strategy, where the compound rate of return was 12.4, the worst 12 months was a loss of 46.3, so you had a 3% bigger loss. The worst 60 months was 7.3, the worst drawdown was 55.8. And these differences are hidden in any investment we make. It's just, I can tell you, the industry does not like to focus a whole lot of time on losing money. They're looking for the people they work for to say yes to the questions they ask them. And if you show them too many negative numbers, they're not sure if that's really for them. And yet, I don't think we should be making a decision without understanding that. I mean, this is like if you were going to look at a set of books for a company because you would want to know all there was about it, wouldn't you want to know how quickly they collect their receivables? And if not, why? And if it's more than is normal in your mind, want to understand why. I mean, this is just something that if you were buying a business and you knew that it had volatility, you'd want to know about that volatility. And that's what we do when we invest. We become shareholders in an investor. We just don't have to go to work with them. So one brilliant decision that we can make in the equity markets is to use index funds. There isn't any argument in favor of actively managed funds. Now, I want to stop and address one that would be obvious. We know, and I'll go to the bottom bullet here, SPIVA, that's the S&P 500. They do a study every 6 months, updated. They show the results of the indexes, and they show the percentages over different time periods, 1, 5, 10, 15, 20 years. How do the actively managed funds do compared to the the indexes? And by the way, this is before taxes. And what do we know? We know that the S&P 500, only 10% of the actively managed funds are able to do better than the benchmark itself. So that's number one. Number two, expenses are forever, which means in the actively managed funds, the expenses are forever going to be higher. Actively managed funds have more turnover, which means more than likely those managers are going to turn that money over. And when they turn it over, there's not only the cost of buying and selling, but they create taxable events. And it turns out, and you can go to Morningstar and verify this, if you look at the S&P 500 versus an actively managed fund in the same category, you will find often, well, it's a range from about 0.5% to 1% a year, higher taxes, therefore lower returns for the owners of actively managed funds. Now, I can tell you ETFs have solved some of that, but most people in actively managed funds are still sitting in traditional actively managed funds. And by the way, these are easy decisions to make when you have them in an IRA. Not quite so easy when you're sitting on some accumulated tax obligations. The SPIA. This is not the S&P 500. The SPIA stands for Single Premium Immediate Annuity. It is what you get when you get your pension. That is a single premium immediate annuity. And they can be very complex, as you know, if you've ever decided what you're going to do about your pension. Do you want to take it second to die? You want to take it with inflation adjuster? There's all sorts of things that you can potentially do that will change the cost and change the benefit. So I often find, as I said earlier, people are leery of doing business with insurance companies. But I will tell you, when I run into somebody who has undersaved and they need high returns, higher cash flow than they could ever afford to take the risk, certainly in equities. I mean, the last thing you want to do for somebody who doesn't have enough money is to suggest they put a bunch of money in equities. The single premium immediate annuity is magic. Now, remember, magic is always a trick. My wife, by the way, for my 80th birthday, and we had the birthday party with the family at our house, surprised me. She hired a magician to come to the house. And I'll tell you, he was right there in front of us, and we still can't figure out how he did some of the things that he did. But I will tell you here, it's easy. It's easy because the way this annuity works is we're part of a pool. And so when I go into the pool, if I put $100,000 in, you can check this on Stan the annuity man's website, because you can put in your number, you can put in your age, whether for a single person or you and your spouse. You can there are all sorts of ways you can use that calculator. But here's the bottom line. They look at me as somebody that doesn't have a whole long time to live, because they're willing to pay me a pot full of money. They're willing to pay me over $1,000 a month for the rest of my life, guaranteed. Now, that's a pretty good deal. And every once in a while, somebody who they think is only going to live to be, well, in fact, I don't even think they expect me to make it to 90. But I could certainly make it to 95. It's not impossible. The medical profession today can almost perform miracles, feels like it. So if I didn't have enough money and I wanted to put my money in a CD, or wanted to put my money in a in some sort of a fixed instrument like a bond. As a matter of fact, if I put my money into the bond, yeah, it will pay me some sort of an interest rate, but could also go down in value if interest rates go up. Then I'm really in trouble. I think the single premium immediate annuity is an amazing policy for people who want to buy an annuity and they want to buy a pension. Because that pension, I found from my 30 plus, 40 years being around this part of the industry, that people with pensions have more peace of mind than almost anybody if the pension and Social Security is enough to cover their cost of living. So pensions have a place. What is interesting about the industry, and if I hadn't met Stan many years ago, and I just haven't met anybody else that knows as much as Stan does, and I know very little. But what I know is that in order to get the right single premium immediate annuity, you have to know how to shop it. And even if you shopped them a week ago, today, the rate could be different. And so Stan gives you, I don't know if there's 50 or 75 companies. He tells you what the different companies are paying for somebody your age who wants single pay or second to die, or wants an inflation adjuster, or in fact, he'll even tell you without selling you anything whether you even should do an inflation adjuster. But you can go and you can see the list, and it shows right now since the last few days, because he doesn't update every day. I think it's every 7 days they update. But that he will give you the name of the company. You want to go to that company and buy that policy? You want to go to your local agent and buy that policy? That's fine. Stan has performed a service. On the other hand, a lot of people just do it with Stan because they can tell how knowledgeable he is about this whole area. And always try. He does not, just so you'll know, he does not use any insurance products that make promises about the future. He makes, I should say, predictions and suggests their promises. He only takes contracts, works with contracts, kinds of annuities and that type of a product, like the MIGAs, where it is the company guarantees this exact payout, nothing more. Anyway, and here I've got, when Reed puts that PDF under in the notes of this thing when it goes on the video when it goes on their website, you'll be able to click through to my interview with Stan. I thought it was terrific. I haven't heard any feedback whether it helped people understand the process better. I hope so. But and by the way, I have no financial relationship with Stan. I do have this. On my website, there's a page of truth tellers. These are people that I know their work as intimately as I can. Some I know better because that's a part of the industry that I have greater knowledge. But Stan is on the list of truth tellers. There are a whole bunch of people there. Larry Swedrow is on the, Rob Berger, the White Coat Investor. There's a whole bunch of people who I think their work is just terrific. And if you never looked at my website ever, except to look at the truth tellers, I think it would be a benefit. Anyway, I hope you do watch this if you're interested in annuities. I also want to mention, and I know I'm over time here. I want to mention some years ago, 2020, November 17th, I had the chance to do a presentation like this And Reed, I think 12 people showed up. And I did my favorite 12 Vanguard funds for retirees. That has become the most popular video on our channel, our video channel, YouTube channel. We have had over 135,000 people watch that video. And so if you're a retiree who hasn't seen that video, I suggest you take a look. I also can never stop selling the fact that our job is to educate, and if you know any way we can help you, your organization in this process, our website, which has over 700 articles and podcasts and videos. There's a free book called We're Talking Millions that you can get. It's a PDF download. I wrote that one. Chris Pedersen is another one of our directors. He wrote Two Funds for Life. It too is available free. A terrific a book for anybody interested in target date funds. And then right here on the island, a third director of our foundation, Paul Hayes, wrote a book called Spending Your Way to Wealth. Yes, that is a plural because it's about more than money. And it's a terrific book. And at the back of his book, Paul got to write to reprint a 16-page synopsis of the Thinking Fast and Slow, the work of Daniel Kahneman, the Nobel Prize winner. He got it in economics, but he is a psychologist. But it's all about it. I read most of the book. It's a 500-page book. Now I'm talking about Kahneman's book, which is why I read all of Paul's book. And that part of the book was 16 pages. But it's really interesting because it is about all of the emotional biases that we have to deal with as an investor. And so not only does Paul give us those, I think there are 48 different biases we have to deal with in his writing of his book. He talks about how that works as a good investor. And there's my information if you want to get our free newsletter. And my email is there for people who want to send me a question. And I tell you, it is a thrill to live on Bainbridge Island with all of you. And my wife and I leave in 2 days. We're in the sun in California. We're heading back and can't wait to get back and be on the island. And thanks for taking the time of joining me here today. I don't know if you want to take any time for questions, Reed.
Well, I will, we're kind of up against it, but if somebody has a burning question, they can pop it in now. Otherwise, as Paul says, he does respond to email.
Yeah, that's right. Let's do it that way. I know I spoke.
It was valuable, and I think that one of the things that you have donated in kind to all of us is the wisdom that you gained for many years in the business, and now sharing the stuff that the people who are trying to sell stuff are less likely to talk about. Like you were saying, let's talk seriously about the risks.
Yep, you got it.
Okay, thank you very much.
Thank you, Reed. Thank you all.
And thank you to not only to the Merriman Financial Education Foundation, but also to the Bainbridge Community Foundation, which has helped to organize these talks.
Absolutely.